All right, so we're diving into Warren Buffett's world way back in 1992.
1992.
Yeah, you might be thinking, isn't that ancient history in the financial world? But uh, trust me on this one.
Right.
There is some timeless wisdom tucked away in his letter to Berkshire Hathaway shareholders that year.
Oh, yeah.
It's like a masterclass in investing,
Absolutely.
even decades later. And we're talking about a year when Berkshire's book value shot up over 20%.
Wow.
So, there's some serious insight in this letter.
Yeah.
We're unpacking everything from his thoughts on market volatility to his big bets on acquisitions.
All right, let's start with the foundation, intrinsic value. This is core to Buffett's entire philosophy.
Okay.
He sees it as the discounted value of future cash flows.
Future cash flows. Okay.
It's not just about the price tag today, but what a business can generate over the long haul. And this applies to any investment, whether it's a stock or bond.
Makes sense. It's like looking beyond the sticker price and figuring out what something is truly worth. And that's where things get interesting, because Buffett isn't a fan of relying solely on book value. He even tells this hilarious story about a bank manager who learned that lesson the hard way.
Oh, yeah, right. The manager was obsessed with acquisitions and ended up paying a premium for a smaller bank.
Oh, wow.
It was a classic case of overpaying for assets based on book value alone.
Oh,
Buffett would much rather snag a good business at a fair price than the other way around.
okay.
He's all about finding companies with strong underlying economics that can stand the test of time.
So let's talk about market volatility, because even back in 92, Buffett was skeptical of trying to time the market or predict its every move.
Right.
He even includes a table in his letter comparing Berkshire's performance to the S&P 500. It's a roller coaster ride, proving his point.
Yeah, there are a few reasons for it. The first tactic, Berkshire's portfolio includes businesses that aren't directly tied to the stock market's whims.
Okay.
Second, investment income gets hit with taxes, which can eat into returns. And third, the bigger Berkshire gets, the harder it is to maintain those sky-high growth rates.
Okay. He even predicts that the S&P 500's returns in the coming decade will be lower than the past decade. He compares market forecasters to fortune tellers, which always makes me laugh.
Oh, yeah.
It's classic Buffett.
Right.
But there's serious wisdom behind that humor. He's saying stocks can't outperform the businesses they represent forever. Eventually, things even out. He understands that sustainable growth comes from solid businesses, not market speculation.
Exactly.
It's like his famous baseball analogy. It's about slugging percentage, hitting those home runs, not just getting on base with every swing.
Yeah.
You want to focus on the quality of your investments, not just the quantity.
Exactly. It's about making those big wins that really drive long-term compounding. And speaking of big wins, let's talk about acquisitions in 1992. Buffett was particularly excited about Central States Indemnity, an insurance company he scooped up.
This guy loves finding businesses with great management and strong economic moats. He even sees parallels between Central States and his first big acquisition, National Indemnity, way back in 1967. It's like a sequel, but in the business world.
Yeah, and both involved acquiring companies from longtime friends, highlighting Buffett's trust in strong relationships and solid leadership. Now remember, Berkshire doesn't just buy anything. They have a very specific checklist.
Okay, give us the inside scoop. What's on the Buffett acquisition checklist?
They're looking for companies with consistent earning power, great returns on equity, low or no debt, and of course, top-notch management. They'll pay a fair price, but they won't overpay just for the sake of growth. It's about finding those hidden gems that are already shining bright.
And he's not just buying whole companies. They're also doing these add-on acquisitions, finding smaller businesses that can bolster their existing companies, like H.A. Brown, one of their shoe companies, buying Lowell Shoe Company, known for its Nursemaid's brand.
That's classic. Buffett always looking for ways to strengthen their existing portfolio and create even more value through strategic acquisitions. It's like building a powerful network of businesses that can support and complement each other.
He even makes this funny comment about how his acquisitions in both 91 and 92 involved families with tons of kids.
Really?
He jokes that it'll be tough to keep that trend going.
Oh, wow.
That's Buffett, for you always finding humor in the details. But beyond the jokes, it's clear he values the entrepreneurial spirit and strong family values often found in these types of businesses. It's about finding those businesses with a heart and soul, not just numbers on a balance sheet.
Right.
Okay, so now we're getting into how Buffett measures Berkshire's true earning power.
Okay.
And he's got this concept called look-through earnings.
Look through earnings.
This is a bit more nuanced than traditional accounting.
Think of it this way. Buffett wants to see the whole picture, not just a snapshot. Look through earnings, include the retained earnings of Berkshire's major investments like Coca-Cola. It's recognizing the potential for that money to flow back to Berkshire someday.
So it's like looking through the lens of future potential, not just what's on the books right now.
Exactly.
Makes sense. And he sets this ambitious goal for those earnings to hit $1.8 billion by the year 2000. That's a pretty hefty target.
It is, and that target informs every capital allocation decision. They make every investment, every acquisition. It all comes back to that goal. It's like having a North Star guiding their every move in the financial world.
So they're always thinking about the long game. It's not just about making a quick buck, but building a sustainable empire of profitable businesses.
Exactly, and that brings us to one of the most fascinating parts of Berkshire's portfolio, their insurance operations, particularly those super cat coverages. This is where we see Buffett's appetite for calculated risk and his trust in exceptional managers.
Right. Break it down for us. What are super cat coverages and why are they such a big deal?
These are policies that other insurers buy to protect themselves from major catastrophes, like hurricanes and earthquakes. Think of it as insurance for the insurance companies.
Wow, so they're taking on massive risk. But before we get to that, what about the combined ratio? I remember that being an important metric in the insurance world.
Absolutely. It measures profitability in the insurance industry. A ratio below 100 means an insurer is making an underwriting profit. Above 100, they're losing money. And 1992 was a particularly rough year for the industry, largely due to Hurricane Andrew.
The most costly hurricane in history at the time, right? I remember Buffett's quote about that. It's only when the tide goes out that you learn who's been swimming naked.
Precisely. And in the world of super cat coverage, Berkshire is a major player. They're one of the few companies with the financial strength and underwriting expertise to take on these enormous risks.
So how do these policies even work? What triggers them to kick in?
Typically, two conditions need to be met. First, the insurer Berkshire is covering has to suffer losses above a certain threshold, their retention.
Okay.
Second, the industry-wide losses from the catastrophe have to be huge, usually billions of dollars.
So it's not just any hurricane or earthquake that activates these policies. It has to be a truly catastrophic event. And Berkshire often limits their exposure by focusing on specific geographical areas or types of events. They're not just randomly writing policies on every possible disaster.
Exactly. They're being very strategic about where they take on risk, and their exposures can be massive. Buffett even mentions having a policy with a potential payout of $100 million for a single event.
Yeah.
He jokes about needing to watch the Weather Channel constantly, which is so classic Buffett.
He makes it sound almost fun, but seriously, they must have some incredible people managing this part of the business.
They do. Buffett considers Ajit Jain, who heads their reinsurance operations, to be the best in the business. It's a combination of financial strength and top-notch underwriting that allows them to play in this high-stakes game.
But pricing these policies must be a nightmare. You can't just rely on historical data when you're dealing with potential global warming impacts and shifting weather patterns.
That's the challenge.
Yeah.
It's a lot of uncertainty to factor in. So Berkshire takes a very conservative approach to accounting for these premiums. They don't recognize the revenue until a loss occurs or the policy expires.
So you might see losses reported in any given quarter, but the big profits from super cat business usually show up in the fourth quarter.
Right.
It's like they're playing the long game even within this volatile segment of the insurance world.
Exactly. And despite the inherent volatility, Buffett remains confident that insurance will continue to be a major earnings driver for Berkshire. He sees potential for expansion both directly and indirectly. It's a core part of their strategy.
That's a testament to their long-term vision. They're not just chasing the latest trends. They're building a business designed to thrive for decades to come.
Absolutely. Now let's shift gears and delve into Berkshire's world of common stock investments. They've got a pretty impressive roster of companies in their portfolio, from media giants like Capital Cities ABC to consumer staples like Coca-Cola.
This is where we really see his philosophy of value investing come to life. He's not jumping on the latest fads. He's looking for those solid businesses with long-term potential.
And his approach to stock picking is very similar to his acquisition strategy. He wants to understand the business inside and out, from its long-term prospects and management quality to its price. He's not just looking for a bargain. He's looking for value.
He makes a point of saying that he doesn't separate value and growth investing into two distinct categories. They're intertwined for him.
Exactly. Growth is a component of value. It's not about buying cheap stocks. It's about buying good businesses at the right price. He's also very clear that paying more for a stock than its calculated value is speculation, not investing.
So he's not afraid to walk away from a deal if the price isn't right, even if everyone else is jumping on the bandwagon. It's that discipline that has set him apart for decades.
Absolutely.
Yeah.
And he emphasizes that management quality is even more crucial when it comes to stocks compared to bonds. With a bond, the return is pretty much set, but with a stock, the future earnings are directly influenced by the decisions of the management team.
A good management team can take a good business and make it great. A bad management team can run even the best business into the ground. It's all about finding those leaders who can steer the ship effectively and create value for shareholders.
You got it. And speaking of great leaders, Buffett highlights his acquisition of a large stake in General Dynamics in 1992. Initially, he was interested in an arbitrage opportunity, but he's quickly impressed by CEO Bill Anders and his turnaround strategy.
It's another example of Buffett recognizing a winning team and shifting from a short-term play to a long-term investment. He's not afraid to adapt his strategy as new information emerges. He's always learning and evolving as an investor.
And that's what makes him so fascinating to study. He's not just following a formula, he's thinking critically and making decisions based on a deep understanding of the businesses he's considering.
Well, we've covered a lot of ground in part one of our deep dive, from intrinsic value and market volatility to acquisitions and super cat coverages. It's incredible how much wisdom is packed into Buffett's 1992 letter.
It's like a time capsule of investing insights that are still relevant today, but we're just getting started. There's so much more to explore, from his fixed income investments and views on accounting rules to his personal reflections on management and shareholder matters.
Join us for part two of our deep dive, where we'll unpack even more of Buffett's timeless wisdom and uncover the hidden gems that can help you navigate the complexities of the financial world. Okay, back for more Buffett wisdom from 1992.
Yeah.
We're picking up where we left off, diving deeper into Berkshire's portfolio and uncovering more of those timeless investing principles.
Right. One thing that really struck me in this letter is how Buffett thinks about risk.
Risk.
It's not just about avoiding losses. It's about understanding the nature of the risks you're taking and having the financial strength to weather any storm.
Right. He's not afraid of volatility, especially in the short term. He's more focused on those slugging percentage plays, those big swings that can really drive long-term returns.
Yeah, and a perfect example of this is his experience with Salomon Brothers.
Salomon Brothers.
It was a tumultuous time for the firm, but it also provided valuable lessons about risk management and the importance of reputation.
So back in '91, a major trading scandal hit. Salomon and Buffett stepped in as interim chairman. It must have been a huge distraction from his role at Berkshire.
It was, but he felt a responsibility to help right the ship. He spent 10 months at Salomon working tirelessly to rebuild trust with regulators and clients. He even credits several key Salomon executives with playing a crucial role in saving the company: Derek Mulligan, Bob Denham, Don Howard, and John McFarlane.
He also mentions Ron Olson, Salomon's lead lawyer during the crisis. He describes Ron as having exceptional legal, business, and people skills, all essential qualities for navigating that situation.
Absolutely. Sometimes you have to step outside your comfort zone and tackle those unexpected challenges, especially when the stakes are high, and having the right people by your side is crucial.
This whole episode with Salomon really highlights the importance of integrity and ethical leadership. It's not just about making money. It's about building a company that people trust and respect.
Exactly. And it's refreshing to see that Buffett is also willing to own his mistakes. Remember his admission about misjudging the airline industry?
The airline industry.
It's a reminder that even the best investors can get it wrong. Sometimes the key is to learn from those mistakes and keep moving forward.
It takes humility to admit you were wrong, especially when you're Warren Buffett. But that's also what makes him so credible. He's not afraid to show his human side.
Right now, let's shift gears and talk about one of Buffett's favorite topics: capital allocation.
Capital allocation.
He's obsessed with finding the most effective ways to deploy Berkshire's capital to maximize long-term returns.
He seems to approach it like a giant puzzle, always searching for those perfect pieces that fit together to create a powerful and profitable whole.
That's a great way to put it. He sees capital allocation as a continuous process, constantly evaluating opportunities and adapting as conditions change. He even describes his stock-picking process as similar to evaluating a business for acquisition. He wants to understand the business, its prospects, its management, and of course the price.
He's looking for value, not just a bargain. He's willing to be patient and wait for the right opportunity.
Right, and he's skeptical of relying solely on traditional metrics like price to book or price-earnings ratios.
Price to book.
Those numbers can be useful, but they don't always tell the whole story.
He emphasizes that growth is crucial for value creation, but only if it's the right kind of growth.
It's about the rate of return on that incremental capital. If a company can reinvest its earnings at high rates of return, that's a powerful engine for value creation. But if they're reinvesting at low rates, growth can actually destroy value. It's like pouring money into a leaky bucket.
That's a perfect analogy. It's not just about growing for the sake of growth. It's about growing in a way that generates sustainable profits. And of course, Buffett always emphasizes the importance of management. He wants to partner with leaders who are honest, competent, and passionate about their businesses.
He sees strong management as the backbone of any successful investment. He looks for leaders who are aligned with shareholder interests and have a proven track record of making smart decisions.
Okay, now let's talk about another recurring theme in his 1992 letter, Integrity. He's incredibly critical of executives who play accounting games or try to manipulate earnings.
He sees those tactics as not only unethical, but also short-sighted. It erodes trust with shareholders and ultimately damages a company's reputation.
It's about building a sustainable business, not just inflating numbers for a temporary gain. He contrasts this with Berkshire's commitment to transparency and honest financial reporting. They want to give shareholders all the information they need to make informed decisions.
Yeah, that commitment to transparency and honesty is one of the reasons Buffett has earned such a loyal following over the years.
He also believes in treating employees fairly and fostering a culture of accountability. He wants to create a company that people are proud to be a part of. It's not just about profits, it's about people.
It's about building a company with a strong foundation built on ethical principles and a genuine commitment to its stakeholders.
Now, before we wrap up this part of our deep dive, I think it's important to consider the context of this letter. 1992 was a different world. The internet was just emerging and globalization was accelerating.
Yeah, it's fascinating to think about how those trends have shaped the investment landscape over the past 3 decades. Technology has disrupted entire industries, and globalization has created both opportunities and challenges.
So if Buffett were writing this letter today, in 2025, what new insights or challenges might he address? How do you think his thinking might have evolved given these massive shifts?
That's a great question. I think he would definitely have something to say about the impact of technology on businesses and the need to adapt and innovate to stay ahead of the curve.
He might even have some thoughts on the growing importance of sustainability and the role businesses can play in addressing environmental and social issues. These are topics that are increasingly top of mind for investors today.
Absolutely. And he might offer some guidance on how to navigate the complexities of an increasingly interconnected global economy.
So while the specific companies and industries might have changed, the underlying principles of value investing, long-term thinking, and ethical leadership remain as relevant as ever.
Exactly. Those principles have stood the test of time, proving their value across decades and market cycles.
We've covered a lot of ground in the second part of our deep dive, from managing risk and the importance of reputation to capital allocation and the ever-present need for integrity.
But there's still more to uncover in the final part. We'll explore the more philosophical aspects of Buffett's approach, his views on the nature of value, the importance of patience, and the role of luck in investing.
Join us for part 3, where we'll wrap up our exploration of Warren Buffett's 1992 letter and extract those final nuggets of wisdom that can help you become a more informed and successful investor. Okay, welcome back. So for this final part, I really want to explore the deeper philosophy behind everything we've talked about in Warren Buffett's 1992 letter.
Yeah, it's like we're going beyond just the numbers and the strategies.
Well, yeah, exactly.
We're getting into the mindset.
Exactly. And one theme that really jumps out at me is this idea of patience.
Oh, absolutely. Patience is key, especially like you said in today's world where it feels like everything is moving at warp speed.
Right.
But Buffett has always been a big believer in that long game, letting your investments grow over time. Like that quote about someone sitting in the shade today because someone planted a tree a long time ago.
Yeah. It's about resisting that urge to chase every little quick profit and instead really focusing on building something substantial over the long term.
Exactly. And that takes discipline. You can't get caught up in the hype or the fear that's driving all this short-term trading.
Yeah. He compares the market to a manic depressive. Always either offering you amazing deals or trying to scare you into selling.
That's a great analogy.
So you have to be able to step back and recognize those emotional swings.
Absolutely.
And not let them dictate your actions.
It's about having a plan and sticking to it, even when things get a little bit rocky.
Okay, so that brings us to another really interesting point, that Buffett brings up the role of luck in investing.
Yeah.
And he admits that luck has definitely played a part in his own success.
Sure.
Being born in the right place at the right time, having mentors and access to certain resources.
Right place, right time.
But he also emphasizes that you can actually increase your chances of getting lucky.
Oh, absolutely. It's all about being prepared.
Yeah.
You're putting in the work, developing your knowledge, your skills, building your network.
Yeah, like setting the stage.
Exactly, setting the stage for luck to strike.
It's like that baseball analogy he uses. It's like a batter waiting for the perfect pitch. You can't control what the pitcher throws, but you can be ready to swing when you get one you like.
Yeah, you got to be ready.
So as we wrap up our deep dive into Warren Buffett's 1992 letter, what's the biggest takeaway for our listeners? What one thing should they really walk away with and apply to their own investment journey?
I think for me, it really comes back to the fundamentals, Understand the businesses you're investing in,
Yeah.
assess their long-term prospects, and learn how to value them appropriately.
It's about taking that long view, being patient, and not letting the day-to-day market noise distract you.
Exactly. Making decisions based on logic and reason, not your emotions.
Yeah, and remembering that luck favors the prepared mind, so the more you learn and grow, the better your chances of success.
Couldn't have said it better myself.
So that's it for our deep dive into Warren Buffett's 1992 letter to shareholders. We hope you found it valuable and insightful. And as always, we encourage you to keep learning, keep growing, and keep investing wisely.